All right, so this week I'm going to talk about the most obvious thing, which is that what's going on with our stocks, what's the outlook going from here, and lay out a few things that I believe really point to a turning point. I'm obviously hesitant to call a bottom again, having gotten this wrong a number of times in 2021. However, there's a lot of good signs. And actually, I've been tweeting a lot about this. And we'll put up some tweets as well as I talk about this. So the first thing I want to say is that for folks who started buying in February, hey, I get it. You know, you're down hard. Nonetheless, the only way to really invest ever is to look forward. And if you invest for any period of time, I'm going to break this to you, which is that you're going to have to go through a period like what we just went through, which is that crashes, corrections, declines, losses, they're all part of investing. And this is one reason why so often on our updates for Profits Unlimited, I focus on something called Rules of the Game. And you'll find videos on our channel on Rules of the Game. And there's a report called Rules of the Game that we issue and that we ask everyone to follow. But I'm not going to talk about Rules of the Game this week. I want to talk about looking forward, what is likely to happen, point to some things that are setting up, I believe, that are massively in our favor, and then also deal with some objections that are commonly cited in regular media. So first, let's start with some of the big catalysts that are pointing to and suggesting that if we're not at the bottom, we're definitely very, 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 very close. All right. And so point number one, which I put out on Twitter yesterday, which is that somehow everyone seemed to have come up with the same idea to bet on options that expire on January 21st, 2022. And you'll see this tweet here where I point to this, and you can see there's an amazing $1.3 trillion of single stock options, which expired on January 21st, 2022. So that was on Friday. And in history, this is the second largest expiration of its kind. So tracking back to sort of March of 2020 and then through 2021, I remember from the March COVID crash that the longest expiration that was available at that moment was actually January 21st, 2022 for many of our stocks. And it seems like many people had the same idea to bet on that date. And by betting on that date, you actually expose yourself to market makers who can see these huge number of bets that are building for this date. And it turns out that everyone had more or less the same idea at the same time, which is that give it as much time as possible and bet on a higher price. And what happens if everyone bets on one side? Well, the market makers, the dealers, they're on the other side. And truthfully, the dealers and the market makers can never lose. I mean, you know, they are the house. For you to collect your bet, they have to win because they're the ones that, you know, ultimately have to keep taking the trades. Anytime you go to buy or sell a stock, or you go to trade an option, most of the time you're dealing with a market maker or a dealer. So the short term, they're the ones that make markets, and there's no way that they can be run out of business if everyone's going to take one side. So it turns out that there was a huge, massive, like a historic size bet set up to expire all on the same day, January 21st of 2022. And I believe that this has sat as a massive overhang, particularly on our stocks, because that is where I believe that the bets were. Now, I have not been able to find specific evidence, but I believe that once you get past the big names, I believe that there was in all likelihood billions and billions of dollars that was bet on these stocks going to much higher prices. And now the overhang of this bet is over. It's gone. It's expired. People have taken large losses. I mean, 1.3 trillion. And if you look at that picture, there were also other bets on indices. I'm just focusing on single stock options expiration. So it's 1.3 trillion, a massive, massive amount of money in notional value. The actual money that was bet was less, but what it represented, is a lot of money. So that overhang is now gone. So that's a pretty big deal. And then I found this chart which talked about something called gamma, which is now at the lowest point since March of 2020. And I have to be truthful and say I'm not an expert on options. Ian is more expert than I am. And so we'll cover this chart in greater detail on the Incast. But the important thing to remember for this video is that the dealers, with respect to this option statistic, they are now positioned in line with us. In other words, from what my understanding is, they are now effectively short puts. In other words, people after 3 or 6 months of our stocks going down have positioned themselves to think that stocks are going to keep going down. And once again, the market makers and the dealers are on the other side of that. They have taken these bets, which means it's in their interest now to push stocks higher and make these put options lose value because they are the ones that are on the hook for this. Now, that could be a controversial argument for some people. Nonetheless, remember, this channel is opinion, not advice. And these are our interpretations of the data and information that we are seeing. So for us, this goods, because option prices ultimately are dictated by two things: the price of the stock and then the option premium. And so if we're right, which is that the expiration of all these most likely call options, $1.3 trillion has lifted an overhang for the equity market because those option expirations definitely affected the stock prices. And then we've got the dealers and market makers in options positioned where they would benefit from rising prices. That's catalyst number two that is in our favor. And I am willing to go on a limb and say I believe that a lot of stock options are in our stocks because these are growth stocks, they're very volatile, and they've seen the biggest downside. So in all likelihood, the most number of puts and things like that are in our kinds of stocks. And it is in the nature of people to pile on at the end. That is a definite feature of most markets. And another pointer in this direction is another chart that shows the positioning of mutual fund managers, of what's called long equity fund managers. And generally, that's a contrarian indicator. And it shows that many, or maybe even most, mutual fund managers have positioned themselves in banks, late cyclicals that usually mark the end of that type of trade, and are a bad sign because, once again, those folks are long. It means that the market makers and dealers have really no interest in marking that up anymore. And so they're positioned in all the wrong place. So one of the things that Ian and I covered in our last two Iancasts, we showed you using 3 stocks, Zoom, Teladoc, and DocuSign, that our stocks, despite the horrific crash in their stock prices, have continued to grow at very significant levels, 20%, 25%, 30%. And this is after seeing massive surges in 2020 and 2021, where they grew in some cases by hundreds of percent. Zoom, for example, had 3 consecutive quarters of 300% sales growth. So one thing that I believe is going to unfold as 2022 unfolds is that their growth is once again going to be something that is unusual and different, because the America 1.0 companies, the old world companies, are going to go back to either slow growth or, truthfully, even slow decline. And once again, high growth companies like ours are going to be something that is quite different, that you cannot really find in the market. And with that, I believe you will see people come in and start to bid prices higher. And the critical event around that is really their earnings, where people who have sold these companies short, people have sold these companies, thinking that these companies are never going to grow again or going to grow at such slow rates that they don't justify any kind of premium, are going to see that these companies, even if they grow at pretty modest rates, let's say 15 or 20%, well, at a price to sales ratio of 6 and 8 and 10, they are cheaper, significantly cheaper than companies that are growing far slower, far slower. So stock markets are usually driven by comparisons based on growth, comparisons based on quarters. So as the fourth quarter earnings get announced, we are going to hear companies tell you what happened in the fourth quarter. However, more importantly, project forward and say, well, we're not really seeing any signs of a massive slowdown in our business, or we're seeing a slight slowdown. It's still at a 15 or 20 or 25% level. And then what portfolio managers will do is compare that relative to various things that they use to value these companies. And for growth companies, it's always sales growth, and it's always price to sales. And I believe that they're going to say, whoa, these companies are too cheap relative to their growth, and they're going to come to bid them up. And as they come to bid them up, you will find other people will come to cover their shorts, build position themselves, and now the momentum rolls in the other direction. So that's another significant catalyst that is coming in our favor as well. Now, the fourth thing is a little bit complicated, and this video is going to go long because I just need to explain it in a little bit. And I tweeted about this as well, which is that there is actually a massive buildup of inventory that is mostly downstream. And by downstream, I mean that it's closer to the ports rather than, at the store level, at the retail level. However, even at those levels, there's a lot of inventory that is sitting there and it's building. Earlier this month, I put up a tweet talking about, I think it was like 100 plus ships that are really clustered all around the United States waiting to unload. And those ships represent even more inventory. And I follow something called the Logistical Managers Index, where in their December report, they said very unusually, inventories are continuing to build into December. That's unusual because usually after the holidays, most people would report lower inventory, having sold gifts and all kinds of merchandise for the holidays. So very unusual. And their report also pointed to the fact that these inventories were actually starting to build even more, and they're not counting the ships that are all, clustered around the United States waiting to unload. So we are setting up for a scenario where we are going to see more and more and more inventory get pushed into the system, where we'll face pressure on transportation, pressure on warehousing, but more importantly, pressure on prices. Because when there is too much inventory, retailers, whoever is selling, is now going to be quite incented to cut prices. And if you think about what is the central concern that has driven our stocks down, at least if you believe the media, it's the question of inflation and interest rates. And when I go and research it, the question of inflation is about a lack of inventory at many levels, which is allowing retailers to lift prices. And if you have a surplus of inventory, you would have the reverse happen. In other words, there would be plenty of inventory. And not only that, companies have to carry inventory on their balance sheet and finance it. And so it's a cost. And if those prices are being cut, it's a cost that has increasing sort of impact on it, because now you have to, every quarter, you have to report on your inventory. And if the prices are being lowered, you will have to actually take a charge on your income statement. So that's pretty tough, because a lot of the companies that really have overordered are America 1.0 companies, old world companies, because they're the ones that make goods. A lot of our companies are in the business of intellectual property. So they're really not in this game at all. So we've got now the scenario where this central concern around inflation, interest rates, we believe can go in reverse, and dramatically in reverse, because as I've mentioned, inventories are already piled up. And we got more coming in, and there's no sign of any let up. It does seem like people have overordered by a factor of maybe 3 or 4 or 5. So we're going to see prices, I believe, reverse. With that, the inflation fears will reverse. With that, the pressure on needing to lift interest rates to whatever it is that people fear, 3 times, 6 times, 10 times, whatever, is also going to reverse. And the markets will sniff that out and sense that well ahead of the Federal Reserve actually saying anything. Because people will start to report it with the fourth quarter earnings that, which is now happening right now. And people say, oh, inventories are beginning to rise. We don't foresee any supply chain problems going out past, let's say, March or April. In fact, we see the reverse. And the markets will take that observation from any single one company and extrapolate it to all the other companies in the same business. And then we'll quickly work out that there is too much inventory in the channel, too much inventory in the system, and that will reverberate again through inflation, interest rates. So bottom line to this video is that we've got a number of things setting up really to reverse what has been a very, very difficult 2021 and thus far in 2022. One is a massive expiration of options, like a historic, the second largest in history, $1.3 trillion of single stock options. I believe the vast majority of those are calls because the setup prior to that really was of rising markets where people were betting on even higher prices and truthfully have been wiped out. So it's a massive, massive overhang on the market that is gone. The other one is the positioning of option dealers who now are in the same place that they were in March of 2020, when I believe that they are sitting on inventory that include our stocks, options on our stocks, put options where they want the put options really to go down in value, and they want our stocks to go up. So the dealers and market makers are on our side. We've got quarterly earnings coming up where I believe that into a scenario where our stocks have gone down by whatever, 30, 50, 70%. They are cheap. They're still going to show growth in a period where many others are going to be showing slowing growth and or a reversion back to what they were pre-pandemic, which is slow growth or slow decline, which is going to make people want to bid them up. And then we've got this macro thing going on where concerns about inflation and interest rates, which is driven around a lack of supply of many things that is related to pandemic shutdowns, is about to reverse itself in a quite dramatic fashion to go completely to the other side, which then would offset people's concerns about inflation, interest rates. And the bottom line for us to all of this is that it drives demand for our stocks, which are high growth. Now they're low multiple. And in a growth-constrained world, in a world where you have oversupply of goods, where their growth rates are unique, they are different, and they are going to be valued once again at a premium. In other words, people are going to come in and bid them higher and keep bidding them higher because this oversupply is not going to be cured anytime soon. I put out another tweet talking about there's 4 forces of deflation. One is the over-inventorying and over-ordering that I've gone through. Second is the fact that the pandemic is going to recede. It's not going to last with us forever. So maybe it recedes over 3 months, 6 months. But every pandemic I've studied, the biggest effects are really in the first 2 years. After that, it starts to recede. So what is going to happen after that? Well, the world is going to go back to full production. So in other words, we're going to produce even more stuff that's in there. And then in the meantime, because of the supply chain issues, the United States, at least, and other countries are reshoring. They're increasing production even more closer to where the end demand is. So even more production is coming. And finally, if you go look at our technologies that people, what we're invested in and that people are putting in as they reshore and put up new production and manufacturing or facilities, I mean, they're way more productive. They are so much more efficient. They're so much cheaper. So they're going to represent low price inventory that represents, even more inventory that's going to be coming into channel, more stuff that's going to be made at cheaper prices, which has, again, the effect of lowering prices, lowering inflation, causing deflation outright, which will, again, pressure interest rates. And once again, makes our stocks into something that is scarce and unique and worth bidding up because they have the most scarce thing if you're looking out 1, 3, 5 years, which are our time frame, which is growth and growth through innovation. So I know it's been a difficult 2022 following a very difficult 2021. However, I believe that we've got now very significant catalysts to turn this around. So please, I know the trolls will come at me for saying it, but I'll take it. Try to be strong hands. Try to stay bullish. Try to stay optimistic. Try to stay positive. Our time is coming. And follow me on Twitter so you can see all of the tweets that I have put up. Until next week, this is Paul saying bye.